Your Series B data room has a documentation gap that will kill your deal in the first 48 hours of investor access, and your legal team probably hasn't flagged it yet. Most founders treat the data room like a file upload task. Series B investors treat it as the first real test of whether you can handle institutional grade equity governance. When outside counsel opens your data room and finds missing board consents, cap table software that doesn't reconcile with legal documents, or stale 409A valuations, they don't pause to ask for clarification. They draw a conclusion about management quality, and that conclusion forms before your first partner meeting, and it's what causes deals to die before formal diligence even begins. This is for founders raising $5 million to $50 million who think their data room is ready because it looks organized. If you're still figuring out what belongs in a Series B data room, this video is not for you. We're covering the specific documentation failures that kill deals in the first review cycle and why investors read documentation gaps as governance failures, not administrative oversights. Okay, Chapter 1, what documentation gaps kill Series B deals before partner meetings. These are the 6 documentation failures that outside counsel flags first and that lead investors weigh most heavily when forming their initial view of management quality. Missing or unsigned board consents for equity issuances kill more deals than founders realize. A missing board consent doesn't just mean a missing document. It means the issuance may not have been validly authorized, which creates a legal question about whether the equity record itself is reliable. Cap table software that doesn't reconcile with signed legal documents creates immediate uncertainty. When Carta outputs contradicts your legal record, investors cannot determine which version is accurate. That uncertainty makes the equity ledger suspect. Now, stale or missing 409A valuations raise compliance concerns before investors review your metrics. Safe harbor status generally depends on the valuation being within 12 months and no material change having occurred since the valuation date. Here's what most founders miss about how these gaps get discovered. Chapter 2, how investors systematically review data rooms to identify problems. Documentation gaps aren't discovered by accident. Outside counsel follows a structured 4-step review sequence that tests your data room systematically. First, they run a document inventory check. Counsel compares your data room index against a standard Series B diligence checklist and flags every missing category. And now missing categories signal that you either don't have the documents or don't know what's expected. Second, they conduct reconciliation reviews. Investors compare cap table software output against signed legal documents, board consents, and financing agreements to find discrepancies. And mismatch between software and legal records means the equity ledger cannot be verified. Third comes version and date audits. Counsel checks whether documents are current, properly executed, and dated consistently with the equity events they record. Fourth, cross-reference checks between option grant records and employment agreements to find gaps. The cross-reference check is where the most damaging discoveries typically occur. Chapter 3, what happens when cap table software doesn't match legal documents? When your cap table software contradicts signed legal documents, it creates a problem that goes far beyond reconciliation. Investors cannot model their own post-money position when they don't know which record is accurate. The software says one thing, the legal documents say another. And that discrepancy makes the entire equity ledger unreliable for valuation purposes. Here at IRC Partners, we see this constantly with companies that have gone through multiple convertible rounds. The software gets updated for new instruments. The underlying legal documents don't get properly cross-referenced. By Series B, there are material differences between what the system shows and what the legal record proves. The investor's next question isn't, can you fix this? It's, how many other discrepancies are there that we haven't found yet? And that shift from evaluation to investigation is what kills momentum before the first partner meeting. Now, here's the timing issue that makes stale valuations particularly damaging. Chapter 4, how long before Series B companies need 409A valuations? Companies issuing equity to employees, advisors, service providers generally need an independent 409A valuation to comply with Section 409A of the Internal Revenue Code. Safe harbor status generally depends on the valuation being within 12 months and no material change having occurred since the valuation date. Most founders raising Series B have gone through at least one material change event: bridge rounds, new hires, strategic partnerships, revenue milestones. If your last 409A predates any of those events, you've lost safe harbor protection. Option grants issued since that valuation may not have compliant strike prices. That's a tax compliance exposure that investors and their counsel will flag immediately. The timing window is tighter than founders think. 12 months from valuation date, not from when you commissioned it. Material changes reset the clock even sooner. But here's which company profiles are most exposed to these documentation failures. Chapter 5. Which companies are most exposed to data room documentation failures? The 4 company profiles account for the majority of data room problems that counsel identifies during initial review. Companies with advisor, contractor, or strategic partner equity grants are the highest risk. These grants show up in cap table software but were never pampered with signed grant agreements, vesting schedules, or IP assignments. The equity appears in the ledger but has no legal foundation beneath it. Companies that ran bridge or extension rounds often have partial cap table updates, missing board consents for bridge closings, and safe or convertible note instruments that were never added to the data room after execution. Companies with employee or co-founder departures where options were never formally canceled create litigation exposure. The cap table shows departed holders as current equity owners. There's no termination agreement or cancellation notice to prove otherwise. Companies operating for more than 3 years without a recent 409A carry valuation risk on every option grant issued since that stale valuation date. The bridge round profile is particularly common and particularly damaging because founders treated it as a faster, lower formality process. Chapter 6. How missing board consents kill Series B deals before formal diligence. Every equity issuance, option grant, and financing round requires board authorization under corporate law. Missing board consents create legal questions about whether equity was validly issued in the first place. A missing board consent doesn't just mean incomplete paperwork, it means the underlying equity event may not have proper corporate authorization. That creates uncertainty about whether the equity holders actually own what the cap table says they own. When outside counsel finds equity issuances without corresponding board consents, they flag it as a corporate governance failure. Now, the question becomes whether management understands the legal requirements for equity administration. If they missed board authorization requirements, what other corporate formalities did they skip? The burden of proof shifts immediately. You no longer are presenting a business opportunity. You're explaining why your equity record should be trusted despite documentation gaps. This brings us to the critical distinction that most founders miss. Chapter 7, the difference between cleanup tasks and governance failures in investor evaluation. Investors don't distinguish between we forgot to upload it and it doesn't exist until proven otherwise. When a document is missing from the data room, the working assumption is that the underlying equity event was not properly handled when it occurred. A missing board consent suggests equity was issued without proper authorization. A missing termination agreement suggests a departed equity holder's claims were never formally resolved. A missing 409A suggests option pricing wasn't handled in compliance with tax requirements. The inference forms before you can explain. Management is no longer being evaluated on business execution. They're being evaluated on whether they understand institutional grade equity governance requirements. And this dynamic is why documentation gaps discovered before the first partner meeting are so difficult to recover from. This question shifts from whether the business is attractive to whether the equity record can be trusted. It's a harder question to answer under diligence pressure than the deal timeline can typically sustain. Chapter 8, how long it takes to build Series B ready data rooms from scratch. The remediation timeline depends entirely on your starting point. For companies that maintained organized equity records and use cap table software consistently, assembling a complete data room takes 4 to 8 weeks when accounting for legal review, reconciliation, and index organization. For companies with documentation gaps, stale valuations, or unreconciled cap table records, the process takes 3 to 6 months. And that timeline assumes you need outside counsel to draft retroactive documents, obtain board ratifications, or commission new 409A valuations. The 3 to 6 month timeline is what kills most Series B processes. Founders realize their documentation isn't ready after they've already started investor conversations. The momentum dies when they're fixing problems that should have been addressed months earlier. Here at IRC Partners, we require founders to complete 4 steps before any data room opens to Series B investors. Run a document audit against a Series B diligence checklist. Reconcile cap table software against every signed legal document. Commission a current 409A if yours is older than 12 months. Build a complete labeled data room index before the first investor conversation. The remediation window closes the moment the investor access is granted. A documentation gap found by the investor before the first partner meeting doesn't just create a cleanup task. It creates a governance question that shifts the entire evaluation from business merits to equity record trustworthiness. And that shift is difficult to reverse when missing documents are eventually produced. The company that enters Series B fundraising with clean documentation has negotiation leverage. The company explaining gaps under diligence pressure is already discounted before valuation discussions begin. If your raise is between $5 million and $250 million, and you want to know if your deal is institutionally ready before you sit across from an LP, there'll be a link in the description in this video. Click that link, schedule a call with our team. We review your structure, your terms, and your capital stack before you walk into the room, and we'll show you exactly what's needed before we take you to market and get that capital.